We talk about capital budgeting here. So capital budgeting is whether you wanted to do something or whether you don't want to do something. So we have two methods. Traditional method, which is non-discount cash flow, modern technique or discounted cash flow, capital budgeting, meaning of definition, summary. Of capital. Capital refers to project. So generation, project level selection, project generation, long-term capital planning, short-term measurement of performance. Then you have project evaluation, project selection. So project evaluation is traditional, payback, accounting, modern, NPV, internal discount. Just notice payback period method, accounting of return model. The discounted payback method is net present value, internal rate of return, profitability. Payback period is initial investment upon annual cash flow, accept reject cash flow. So PV is a full recovery amount of your cash flows. Then you have a limitation of payback. It is not appropriate method, and this does not consider cash flows yielding invested. It does not take into time value of money. It is not scalable. It is not consistent. Accept or reject. Decision to accept a proposal depends on how much payback figures compare with a standard example. So payback is equal to annual cash flow. Just remember that in these type of question, actual investment, changing net working capital, release of that net working capital, and things like that become important. So those things are quite important. Then you have limitation of NPV method. Net present value is this countermeasure of NPV. NPV is greater than 0. Merits of NPV. Project A, project B. Then NPV is greater than 0. Project. Then you have IRR. So IRR is another method represented as R. Response by trial and this method evaluation share discount rate. Generally, IRR may lie between two discounting factor in case of interpolation. Merits of IRR, NPV versus IRR method in interest rate investment was computation amount the maximum rate of return. Assume the cash flow reinvestment discounting rate. It assumes that cash flow reinvestment discounting is a new project reinvestment simply cut off. Then you have profitability index and discounted benefit ratio. This is under discounted evaluation of proposals. PI is the rate of which future cash flow defined. So PV of cash flow upon initial outlay. So I and P versus profitability is compared appraising investment method. If PI is greater than 1, PI satisfies almost all, it gives considerable time to value, it considers all get help. So present value, factor, present value upon initial conflict. So that is the PI factor, which takes into account everything. That was very quickly about capital budgeting.